Hey everyone, it's me again, and I wanted to talk more about tails because why? They're just so cool. So, a couple things on Amoa, on a Mountain of Alpha, we got a few features implemented. Let me see, let me go to one of these. So, on the portfolio simulation, you can now gate the sizing of your trades based on VIX, the volatility index. So that's kind of cool. And you can also invest the cash in a treasury or a T bill. And the carry is obviously month to month or mark to market. I think that's what that means there. So that's kind of cool, right? And what's interesting about this kind of trading, let me go back, is you can really identify where the strategy is most likely to occur. And in this case, I'm testing the tail strategy. Let me cancel this, go here, and I got this particular tail strategy, which is just an extension of the Amoa one down here, with just some slight modifications for, uh, broadening out how many equities you see. There are some total open interest changes, and I did this IV at the money is greater than the realized 50, the skew. And that's okay. It doesn't change much. It helps slightly reduce the drawdown, not by much though, so you can almost just get rid of this. But on the backtesting ones, what's interesting is um, you could see here how the first one here is a 39% CAGR with a 24% drawdown. Now this is uh, mark to market monthly. So it's not really the drawdown, it's kind of a fake drawdown number. Uh, and that's one thing I've implemented again. But you could see here that if I scale the trades based on volatility, because that's what these are doing, then I can capture more CAGR by allocating to certain volatility events. And so if I go into one here, is that you can see I'm like investing cash every 3 months, and I'm VIX gating it. So I do 10x the size when VIX is above 30. Well, why 30? It's kind of just eyeballed. I really didn't really look at a lot of things, but 30, if I just draw it there, you can see like you're triggering some really big volatility events, right? And so I just kind of randomly picked the number. I don't know what percentile that is, but it's just a number and it came out pretty good. All right. So it slightly reduces drawdown and does help with the compound annual growth rate. So that's kind of cool. You could kind of modify those things. Now, there's not a lot of these trades that happen. And I talked about that previously. And if I kind of run this back test, and this one versus last time is I excluded a lot of other uh, industries. I think automobiles I got rid of, which would get rid of Tesla, which is one of the biggest winners, but it prevents a lot of trades in like Ford and like, GM and weird things like that. So it's kind of a trade off whether you want these or not. But I did increase the universe percentile to less than 30. Now, this doesn't have a tremendous impact, but it does help reduce your drawdown because, well, you want to buy something that's lowest relative to the market. That way your drawdown would hence be less, right? You're buying things that have less vol. Now, with the MCP aspect of this is that there's a lot of things that the MCP can do with Amoa. So if I go into the MCP in here, right, and then I pull up the Amoa MCP, re-authenticate. So I'm authenticating with Mountain of Alpha, right? And now I'm hooked up. And then I could just say things like, yo, bro, look at my tail trade Amoa screener, right? And that's going to call the screener I have. yo, found your tail trade screener, let me run it live. And it's going to run it. And it should pull up these 15 names. There you go. Right? So it pulled up the 15 names, and there's some gating on these things. Now, one thing that's kind of interesting about this is that these have a lot of requirements in how you enter. I'll give you an example. Go to one over here. So we have, you're buying single leg calls, delta of 10, but you can buy a 5 delta and up to a 12 delta, right? And then there's an expiration, days to expiration bucket, where what I eventually did is I downloaded the trades from a less strict version of this, and then I used Claude to bucket the returns by days to expiration. And basically everything over 790 days failed. Well, the reason it failed is because you're just holding onto it for so long that eventually these high-flying names sell off, right? So anything over 790 days failed, even though a lot of these were up like 10,000% at some point. But because it's a tail strategy, you can't have a cap on when you do returns. Now you could probably maybe find like your mean return and then cap it there or something, but I found when you're kind of nickel and diming these tail trades, you're trying to capture massive tails. Another thing is that there's also a gating in which the delta, this 10 delta that you're going to buy, can't be extraordinarily above spot. And I can't remember, I think it was Coin. I think this is the one. Oh, by the way, the website is much faster, right? Look at this. Boom, 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 boom. Look at that. And like all the date spans load very quickly. So I did a lot of performance things here, and the site works very well. But let me go to Coin and show you. I think it's Coin. And so 876, we're not doing that. That's outside the bounds. 694 has a 32 delta. 547 has an 18 delta. 512 has, here we go, a 12 delta, which I think in the database is like 11.6 or something like that. It just rounds. But it's 880, right? And spot is 161. And all those trades in the back test over 13 years never worked. So there is a gating requirement on spot relative to the strike, right? It can't be that high. Like, what is that? That's, what was it, 880? What was spot? I don't know. I'll make up a number. 685%, right? Like, that's dumb, right? So there's this gating here, and things that were only 40% above were either because like the quote was really funky, or it was just a low liquidity name or something crazy. And so that's why it's 440 to 160%. And then there's also this closing price thing about quotes, that if you have no double-sided quote, you can take just the last close. I think I already talked about that. And now there's the VIX gating and the cash-related carry. Now, the cash-related carry on tail trades, you're not really going to see show up, but it does matter, right? So that's a part of the equation. One thing I did find on this tail strategy is that the gating of revenue growth was a massive driver. And if you got rid of this, the tail trade strategy fails in 2022, which was the year of the big mega cap pullbacks. And there is also something here that didn't have much effect, but it might in this one. Let's see. Let me grab this one, duplicate that. I'm going to add a VIX percentile just to not buy things when VIX is in the bottom 10 percentile. That's what that does. I'm assuming no contract pricing, like you're on Robinhood or something, which is kind of good. Robinhood gives you, what, 3.25, something like that, 3.5. on uninvested cash. So that kind of, works well in tail strategies where um, the uninvested cash can actually earn money without, like Schwab is like 0.1 or something, right? And what you'll find is that with this VIX gating, most of the time you're sitting in 60 to 90% cash, right? Because you just don't have enough trades, or you don't have your volatility event, or whatever the case may be. So, and especially if rates now are at, I mean, the 30-year yield's busting above 5%, right? So, like, risk premium is becoming a factor. And, okay, so I think this VIX gating, so this VIX gating dropped the drawdown by 1%. However, this drawdown is actually fake. It's not actually true. It's probably around 45% because we don't have the cadence on daily mark to market. Now, we could do that just to see what it is. And this is probably going to cause problems in COVID, which is probably fine. So you could do this, mark the equity curve daily. Now, this is going to be a lot slower, of course, because you're doing it daily, not monthly. But at least you'll get a semi-true number, which is not going to be entirely accurate because quotes tend to, like, when you're dealing with wings, the quotes on those wings can vary dramatically. And so you're not, oh, see, there you go. See that, like, one spike there? That's like some really dumb one-sided quote print. So you got to be careful sometimes when you're, like, looking at some of this stuff on a mark-to-market daily, because, well, that's just how the nature of tails work, right? So this is going to take a little bit longer. Okay, now we're at 34%, see? But we still haven't hit 2022, which is probably the worst year. So we'll see what happens there. But the whole point here is that you're buying long-dated leaps, and you're trying to just sit in the trade and have it work for you. And what you'll find in this is that if you look at the yearly return profile, all of it comes in 2022 or 2020, I think it is. And that's because you had the massive vol event, which everyone started buying put protection and getting out of calls, which lowered the delta on the calls, the implied volatility on the calls, which pushed the deltas down. And then you're basically buying in events where everyone's panicking, right? And you're just trying to trust the process and the strategy to work. And that's going to be very hard to do because a lot of people aren't going to be able to have drawdowns. They're not going to be able to deal with it, right? Now this is like, what is this? Oh, I can't zoom while it's going. That's okay, we'll zoom in a second. Yeah, I don't actually see, like, where this came from, where that 43% came from. It might be a bug. Because it came in somewhere here, right? Like, 43% would be like a pretty big drop, but I don't see it in here. Maybe this doesn't draw the drawdown. Okay, it said 43% during 2020, but I don't see that on the graph, so this is probably plotting the cash position nav. It's not actually plotting the portfolio's return profile, so that's probably a bug. But you could see the outlier it made in that year because you essentially bought the COVID dip. You see here, like, March 20th. So you see in March it snapped up all of these trades and they went bonkers, right? So look, 10,000, 10,000, 10,000, 10,000. So you're pretty much allocating a large percentage of the portfolio when shit hits the fan. And that carries a lot of the portfolio. But if you got rid of this, I think the annualized vol was like 20 something percent, which is fine. That, I mean, on an options portfolio, that's fine. That's crazy. That's okay. But I think a lot of people won't be able to stomach a lot of this stuff. But hey, like, you get crazy returns and you just got to trust the process. Now, there's another thing to this, is that if I started this portfolio at different eras, it may produce different results. I've never run that, but we can. And you could do that with a backtest. So here, I'm going to add a simulation. And, oh, I'm only allocating 90% of the portfolio. So that's something there. I didn't realize that. And here, I could do like, oh, run it from 2019 to 01 to 2023 or 4, because we need, you need some leaps in there, right? And so then I could run the same portfolio as if I started it in this year. So I'm only going to start with 1,000 in 2019, right? And let's see if this works. I don't know. I haven't tested this. Now, this is probably going to be very slow because it's day to day. But we can talk about the market. So check this out. Back here, we were at the P10 of VIX, and I was anticipating a rise to 20. Look at that. You hit 20. Wow. Thank you, Amoa, for helping us plot that out. So VIX pins gamma. You could see now it's sitting at 18 to 25. So we can probably expect some fireworks into August. Now remember, I told you that July through August is volatility events. So I'm not allocating any more money to anything right now. And remember, like once we get up into the 25-30s, you should start seeing tail trades that are going to start showing up, because that's historically how the tail trade works. And so if I go back, I'm just going to hit B. B goes back one day, and then V goes back to the next month OPEX. So I'm just going to go a few days here. Back here, back here, back here. So here, there was this 16.25, and I think I said there, hey, that's probably not going to work. But you could also see this like 18.25. If I zoom out, 25 has some large calls around there. You could see the historical 25 and the historical 16 down here. And I'm going to hit month. I'm going to hit M to go to the next month OPEX. There we go. See? Or the latest date, rather. Right? 17th. And so I could see volatility is expected. Now, it's not guaranteed, right? But it's expected. And if you look at the market, well, there we go. It's kind of rolling over. Tech is rolling over, right? Moving average Y. So maybe we're going to test this area here, 7,200 area, maybe, because it kind of aligns with vol, right? So I'm not allocating to anything else. But what I do expect is that these tail trades, and I think it's worth putting this gate on here. It doesn't happen all the time, but it's good to have here and play that. So when I'm looking through these names and I do the chains, obviously all of these do not pass. I think Z Scholar was one that did pass, because it was right on the cusp. It was like a 14 delta. Was it Z Scholar? Yeah, this one was like a 14.6 or something, but it's 480 over 140. That's 242% higher. So that fails, right? I wouldn't do that. So anyway, I just wanted to bring those up. Everything's much faster on the website. I've been working a lot on the live stuff about how we produce the pins correctly, and I've done a bunch of variations of this using Charm, using Gex, using all sorts of things, and it just doesn't seem to work very well. What seems to work best for me that I found is you're just taking an at the money straddle and doing one standard deviation bars, and then the other points here are just, this is the largest pin, these are one standard deviation moves, and tests and balances are where the open interest is balanced and where the largest put unbalanced would be. So I could tell right now that it's sitting in a lot of puts, right? just because test imbalance is above. And this tends to work, right? It hit the pin, sold off, and it bounced on 1 sigma. This is 1 sigma, right, down here. This is 1 sigma up here, 1 sigma down here. And in the past, it's kind of funky chart. There we go. In the past, it just bounced on the pin, didn't quite get to 1 sigma, rolled over, hugged the balance, and then bounced on the pin, which is the largest open interest, right? So that's kind of good. Also, individual equities, I mean, look at that. Intel had earnings. It came down to the 1 sigma, and then it just, on earnings, rallied up into the 1 sigma. And that's where all the volume was. Now, these, on equities, look out to the next OPEX. They don't look out 1 week. They look out to the next OPEX. And that just helps you see levels better, and it helps you see like more activity. Because I was doing stuff like SpaceX, like the next OPEX, and it looked really bad. And so now things look out more. So I could see like it's in a lot of puts right now because the balance is much higher. So that's kind of working, and it goes out to the next OPEX. So that's, well, I can't go forward, right? It's next month on the 3rd Friday, right? So anyway, that's what I got, and I'll keep you updated on some of the tails. And if we start getting some volatility coming into the market, that's when a lot of the tail names are going to start coming up. And so you can see, like, if I go back, this move here, that was the drawdown, which makes sense. I mean, if most people are taking on a 35% drawdown in an index, right? But you look at the portfolio, which, let me refresh because there's a, here we go. Oh yeah, see? So you see, like, if you started your portfolio before COVID here, it's a much bigger drawdown. See that? So it is gated by regime and portfolio sizing of that regime. And you got to be a bit careful there. Another thing here too is that this type of back testing is very methodical on a day-to-day basis. Very methodical, right? It doesn't make any errors or any type of assumptions a part of the day. Once you have the day, it hits the trigger, it places a trade. It doesn't care about what's going on. It doesn't give a fuck. Now, when COVID's happening here, and you're getting like big volatility movements down and just volatility crashing, it's very unlikely you're going to take immediate action and start gobbling everything up. You know, you're human, right? Like, it's just not going to happen. Like, you get these big volatility events like this, every single day, you're not going to be putting on trades. And so your drawdown would probably be much less. And the bot, or the backtesting, sorry, not the bot, it doesn't know that when you're up in the 60s up here, that the probability a year or two out from now, it's just not going to be 60 anymore. So what I'm saying here is that a human, instead of this hard-coded backtesting where it's like, oh, I'm going to do 10x when VIX is above 30. Well, you're not going to put all your trades on a single day. You're probably not going to do that. And what I mean by that is maybe like you get one trade off, and then volatility comes back in and you get a few more trades off. But when it's 60, right, then maybe you're allocating 10% instead of 5% or whatever. So there's ways to mitigate this drawdown just by having some human judgment rather than a day-to-day mark to market on the portfolio for the drawdown. But you get paid by buying into volatility, right? So, I mean, what did it do through those years? A 29% annualized with a 68% drawdown. So that was 2022 actually got hit as well. well, whatever. If you start with 100 grand, and then in 2 years you're at 14 million, I mean, who cares, right? Like, right? Who cares? So, but anyway, just note that you have to be very careful with when you start this and the type of regime you're in. And right now, everything is all located to AI. They hate everything else, right? They're not buying software, right? And so you do have to take this into account, right? So if you're starting to allocate in 2019, where your volatility is down here at 11, right? You're going to get hit by COVID. And down here, we were at 14, so it's slightly elevated. So it's probably best to wait for a vol event, maybe above 25 or 30, to start the portfolio. That way you're not going to get smashed by this surprise drawdown if you really go into a bear market or something like that. Like 2022 or something. So just be very careful about this stuff. But I like it much more. Um, I like this idea much more because it's essentially a waiting game, and the waiting game is very nice. Now, there is a way to reduce. Hold on, it's just a slight bug there. Oh, that's kind of weird. You can't go into the backtester in live. Um, there is a way to have decent returns with lower vol, right? And now this is probably still, we could do this day to day. Let's do that, right? Like, let me duplicate this. 5, 12, 40, 60, 252, close, or whatever, 40 cents, who cares? Let's close it at the end. And let's just do a flat 1,000. Now, that's probably going to skew things because by the time the portfolio gets to COVID, you're only allocating $1,000 when your portfolio is probably $5 million. And so COVID's not really going to impact the drawdown, right? And we can maybe do a 3x when VIX is over 30. We're going to deploy 100%. We'll invest in a 3-month. We'll add another sim, and don't do the VIX skating. We'll do day to day. It's going to be slower. And fine, that's good. And you could probably gate this by capping the portfolio if you wanted. So you're always going to have 20% invested in T-bills, right? That's pretty much what that means. And total open interest, there's no VIX gating here, which I'll just run this as is. Did I do day to day? Doesn't tell me. Oh, daily, right there. It does tell me. So let's see, like, how bad this is. So 2016 was a bad year. Um, some of these are invalid prints, though. You see that one? So this drawdown is kind of fake. Right there, that's a bit fake. So I wouldn't worry about that one. There's some weird print going on there. Okay, we did COVID. Okay, it's struggling. So when you get a lot of positions open, there's a lot of calculations that have to happen on a day-to-day basis. So you could see, like, oh, we dropped to 30 and it sped up a bit. So you got to be, like, a little patient here. 36, 34. So it's a little bit better. I think this comes out to 20% CAGR. We'll see. Maybe with the VIX gating, it's a little better. But remember, during COVID, everyone took a 35% drawdown. But also remember this. This is an options portfolio. Options portfolios should have much, much, much larger drawdown percentages, right? Relative to the market. So, I think that's pretty good. Like if the drawdown you're getting is the same drawdown as the equity index, everyone's getting murdered. But the fact that you survive and when you come out of it, you destroy the performance of the S&P 500, I think there's something to that. Now, there's probably something there too that maybe in low volatility environments, you can actually hedge the portfolio by buying some tail trade in the S&P 500 to protect the portfolio. Maybe there's something there that you could do, right? But a 35% CAGR with a 36% drawdown, I mean, and that only comes in COVID, and everything else looks fairly stable. I mean, remember, it's an options portfolio, it's not an equity portfolio. So if you can really get out of this COVID related vol and you could figure out bear markets, then you're good to go, right? Like that's fine. So you could see like this flat 100 in cash invested did worse. I mean, you sacrifice 2% drawdown for 6% compound annual growth rate. But remember, you could see how, since it's a tail strategy, all of the returns, or most of the returns, came through this COVID fall event. See? Right there? That's where most of it comes through. And that's what the VIX gating does. The VIX gating allows you to allocate more capital when you get volatility events, and that compounds your tail trade. So maybe there is a strategy there that you could just buy. And what's funny is you could kind of tell in the tail strategy when you have complacency, right? You could almost see the complacency in the portfolio, where the portfolio is not triggering much action because you're flatlining, and then you get your vol events coming up. And you're seeing a lot of flatlining here through after COVID. So maybe there's a lot of complacency in the market. That's also another signal, right? So I'm going to leave you there, and I'll see you guys later.